This week, more than 100 members of the S&P 500 are scheduled to post quarterly results. The question is, will strong earnings be enough to reverse the stock market slide? We're about to find out. Steve Berry is here. He is co-chief investment officer at Goldman Sachs Asset Management, where he helps to oversee more than $74 billion and 40 equity investment strategies across retail and institutional funds. Steve has 25 years of investment experience and is responsible for the investment research of Goldman's U.S. growth strategies, at least at Goldman Sachs Asset Management. Steve, welcome to the Inside Track. Will then earnings be a catalyst for the stock market if we see positive earnings growth, positive revenue growth, perhaps more importantly, will we see the stock market come out of its tailspin?
Eric, I think your point on the revenue growth is crucial here because earnings have been very, very healthy for the matter of 6 or 8 quarters now, a lot on the back of cost cutting. From our perspective, we're going to enter a market environment here where individual stocks will behave very differently, and a lot of that is caused by how companies responded to the depth of the economic crisis, where they invested, and now reaping some of the rewards as the markets are improving on the margin.
Have we gotten to a point where, so to speak, beating on the bottom line, the earnings per share beat versus consensus doesn't matter anymore? We've seen that in so many stocks.
I think that's right. I think that quality of earnings, of which there's only so much you can do on the cost side, and if you don't start to get the revenue response, you're really going to run out of some room here.
So where do you look for revenue growth? The economy is still kind of sluggish, right? Mired in this a bit of a morass when it comes to things like debt negotiations and what have you. A lack of confidence, shall we say, on the part of the consumer and even industrial investment. So where is that revenue growth?
So I think you have to look beyond our borders. And one of the advantages I think we have in our organization is the fact that we are global. We're very broad in what we cover, and we cover it very deeply with local teams. And so this dynamic of where is the growth? And so when we see an employment data come out and the market has a wholesale sell-off, we forget that the U.S. is now maybe half to a little bit more than that of our company's results, particularly if you've got a more global and relevant items that you're selling. So we're more conscious then to get outside of the noise of a data point and think about how these longer-term trends, particularly the emerging middle class around the world, can help drive growth broadly.
If that is the case, I want to focus in on one thing you guys are fairly positive or constructive on, which is financials. There isn't a lot of foreign revenue growth for many of the financial stocks outside of, say, of Citigroup. So why be big on banks at this time?
So there are a few things that are very important on the financials. Obviously, you need the credit costs, but importantly, the default and the write-offs. And we see an improvement in the credit side. And that's something
But nobody's giving credit to the banks for that. That is an earnings quality issue. You know, you reverse accruals. Yeah, you get it on the bottom line, but nobody cares.
But reversal of accruals is different than some underlying better credit statistics. And I think the point that you're making here is nobody sees that. We're in a world right now where most investors, money managers, want the data point, want confirmation, rather than thinking about what can happen. And so we do a lot of scenario analyses when we do our analysis because we're anticipating the future. We don't know for sure. And if we can lay out 3 or 4 different scenarios, have some probability adjustment around them, we think we can get a better sense of the risk-reward on each area. And so financials look to us to be very opportunistic here because there's a lot of concern and that we see some improving things underneath.
Well, at some point, it almost goes without saying, they will turn around. But you see stocks like Bank of America sink back into the single digits. Everybody wants to know when the turnaround is coming for the group, if not for that particular stock. Can you see it?
If we can see it, the market can see it. And so we have to be really, that anticipatory dynamic in which we do as fundamental investors is core to what we do. And you can look at some of the activities over the last several weeks, the couple dozen companies that have reported, the consternation going in, whether it was Google on Friday or Nike the weeks before, this whole focus on the cost, one single metric, forgetting that these are enterprises that in fact behave and adapt to the environment is what the market seems to forget from time to time. And the last element, I'd say, we're starting to see some M&A activity of which real buyers are stepping up and saying, Mr. Market, you're mistaken in how you're valuing businesses.
Steve, good of you to join us here in the Inside Track. Steve Berry, co-chief investment officer at Goldman Sachs Asset Management, looking for M&A to set the pace for the stock market.